By the end of this video, you'll understand exactly how paper gold can collapse while physical gold remains in demand. You'll see the historical pattern that connects this event to at least two other major gold crashes, and you'll know what separates the people who panic from the people who profit. This is Jack Goldsman. Welcome to the Jack Goldsman. If you're new here, this channel exists because there's a version of financial reality that gets reported on television, and there's a version that actually happens in the plumbing of the system. I cover the second one. If you want to understand how markets really move, who really moves them, and what that means for your money, subscribe now and turn on notifications. I don't ask nicely because this information isn't nice, it's necessary. And before we go any further, let me be clear, this is not financial advice. I'm not a licensed advisor, I'm an investigator. What I'm about to show you is based on publicly available data, historical precedent, and observable market mechanics. What you do with it is your decision. Now let's get into the timeline. Let me walk you through what happened, because the speed of this move is part of the story. On Tuesday, gold was trading near all-time highs. Sentiment was bullish. Retail traders were piling in. Social media was full of predictions about gold hitting new records. The narrative was simple. Inflation is sticky. Central banks are buying. The dollar is weakening. Gold is going higher. And for a moment, that narrative seemed correct. Gold pushed up through resistance levels that had held for months. It looked like breakout territory. It looked like confirmation. But here's what most people didn't notice. While retail was celebrating, something else was happening in the background. Open interest in gold futures had reached extreme levels. Leveraged long positions had accumulated to a point where the market had become structurally fragile. It was a tower built on borrowed money, and all it needed was a push. That push came on Wednesday, not from a headline, not from a geopolitical event. It came from a margin adjustment. The exchange quietly raised margin requirements on gold futures contracts. This is something that happens regularly, but the timing matters. When margins go up, traders who are already leveraged to the maximum suddenly need to post more collateral. If they can't, their positions get liquidated automatically. And when enough positions get liquidated at once, the selling feeds on itself. Price drops trigger more margin calls. More margin calls trigger more selling. More selling triggers lower prices. It's a cascade. And once it starts, it doesn't stop until the weak hands have been completely flushed out. By Thursday morning, gold had already fallen over $100 from its peak. But the damage wasn't done. The overnight session saw another wave of selling, this time driven by algorithmic trading systems that detected the momentum shift and piled on. These systems don't care about fundamentals. They don't care about inflation data or central bank policy. They see price moving in one direction, and they accelerate it. By Friday, gold had lost more than $200. Positions that had been built over weeks were destroyed in hours. And the people who understood what was happening were already repositioning for the next move. Now, let me explain the mechanism because this is the part that most people never learn. When you buy gold through a futures contract or an ETF, you're not buying gold. You're buying a piece of paper that promises exposure to the price of gold. That paper trades on exchanges. It has margin requirements. It can be leveraged, and it can be liquidated. Physical gold, on the other hand, sits in a vault. It doesn't have margin calls. It doesn't get liquidated at 2 in the morning because an algorithm detected a momentum shift. It just sits there, being gold. This is the difference between paper and physical. And it matters more than most people realize. Think of it like this. Imagine you own a house. You paid cash for it. It's yours. Now imagine your neighbor owns the same kind of house, but he bought it with a mortgage that has a variable interest rate and a clause that says if the payment goes up by a certain amount, the bank can force a sale. You both own houses, but your exposure to the market is completely different. When interest rates spike, you're fine. Your neighbor loses everything. That's what happened in the gold market. The people holding physical gold watched the price drop on their screens, but their gold was still in the vault. The people holding leveraged paper positions watched their accounts get liquidated in real time. Same asset, completely different outcomes. And here's the part that should make you think. While paper gold was being sold in a panic, physical gold premiums actually increased in some markets. Dealers were reporting higher demand for coins and bars, even as the spot price collapsed. This divergence between paper and physical is not an accident. It's a feature of how the market is structured, and it tells you something important about who was really selling and why. The supporting mechanism here is the relationship between the dollar and gold. When the dollar strengthens, gold typically weakens because gold is priced in dollars and becomes more expensive for foreign buyers. In the days leading up to the gold crash, the dollar index spiked on unexpected economic data. This created additional pressure on gold prices at exactly the moment when leveraged positions were most vulnerable. It was a perfect storm. Rising margins, a stronger dollar, and an overcrowded trade all converging at the same time. None of this was hidden. All of this data was available to anyone who knew where to look. But the mainstream narrative stayed focused on the price action, not the mechanics behind it. They told you gold was falling. They didn't tell you why. Now let's talk about the pattern, because this has happened before. In March of 2020, during the initial COVID panic, gold experienced a similar crash. The price dropped sharply even as investors were supposedly fleeing to safe haven assets. Why? Because liquidity dried up across all markets. Traders who were leveraged in gold futures had to sell to meet margin calls in other positions. It wasn't about gold. It was about cash. Everyone needed dollars, and they sold whatever they could to get them. Gold fell, not because it had lost its value as a store of wealth, but because paper gold was being liquidated to cover losses elsewhere. And what happened after that crash? Gold went on to hit all-time highs within months. The people who understood the mechanism and held their physical gold through the panic were rewarded. The people who panicked and sold at the bottom locked in their losses. Go back further. In 2008, during the financial crisis, gold initially fell along with everything else. From March to October of that year, gold dropped significantly even as the banking system was collapsing. Again, the reason was liquidity. Leveraged positions were being unwound across the board. Paper gold was sold, not because gold was worthless, but because traders needed cash to cover margin calls in other markets. And again, what happened after? Gold went from under $1,000 to over $1,900 in the following years. The pattern is consistent. In moments of market stress, paper gold gets liquidated. Physical gold holds its ground. And after the liquidation is over, gold resumes its long-term trend. Once is an accident, twice is a coincidence, 3 times is a pattern. And we're now seeing the same pattern play out again. Let me add a third historical reference to make this even clearer. In 2013, gold experienced one of its most dramatic 2-day crashes in history. Over the span of just 48 hours, gold dropped by more than $200. The narrative at the time was that gold was finished, that the bull market was over, that inflation fears had been overblown. Mainstream analysts declared the death of gold as an investment. But what actually happened? The crash was triggered by massive selling in the paper market, specifically through gold futures and ETF redemptions. Some analysts at the time pointed to unusually large sell orders that appeared designed to trigger stop losses and cascade into a broader liquidation event. Whether this was coordinated or simply opportunistic remains debated, but the mechanics are clear. Paper positions were flushed out violently. Meanwhile, physical gold demand surged. Mints reported shortages. Dealers had waiting lists. The divergence between paper price and physical demand was stark and undeniable. And within a few years, gold had recovered and gone on to set new records. The 2013 crash wasn't the end of gold. It was a transfer of wealth from weak hands to strong hands, from paper to physical, from retail panic sellers to patient accumulators. I know some of you watching this are scared right now. I know you're looking at your portfolio and wondering if you should sell before it gets worse. I know you're reading headlines that say gold is crashing and feeling the pressure to do something, anything, to stop the bleeding. I want to talk to you directly for a moment. There are 3 kinds of people watching this video right now. The first group is scared. You bought gold because you were told it was a safe haven, and now you're watching it fall and you don't understand why. You're questioning whether you made a mistake. You're tempted to sell just to make the pain stop. The second group is confused. You understand that something happened, but you don't understand the mechanics. You're looking for information, trying to figure out if this is a buying opportunity or a warning sign. You want clarity before you make a decision. The third group understands what happened. You've seen this before. You know the difference between paper and physical. You know that volatility in the futures market doesn't change the fundamental case for gold as a store of value. You're not panicking because you've positioned yourself in a way that can weather this kind of storm. If you're in the first group, I want you to ask yourself a question. What are you actually holding? Are you holding physical gold in your possession or in allocated storage? Or are you holding paper exposure through an ETF or a leveraged position? Because your answer to that question determines how you should think about this moment. If you're holding physical gold, the price on your screen is just a number. Your gold is still there. It still has the same properties it had last week. The only thing that changed is what someone is willing to pay for it right now, in a moment of forced liquidation. That price will change again. It always does. If you're holding paper exposure with leverage, you need to understand that you are playing a different game entirely. You're not investing in gold. You're speculating on the short-term price movements of gold derivatives. That's a valid strategy, but it comes with risks that physical gold doesn't have. Margin calls, liquidation, counterparty risk, gap risk. These are real, and they're the reason why some people lost money this week while others didn't. I'm not telling you what to do. That's not my job. This is not financial advice. I'm telling you to understand what you own and why you own it. I'm telling you to make decisions based on your own risk tolerance and your own time horizon, not based on fear or headlines or what someone on social media told you to do. The people who win in markets like this are the people who have a plan before the volatility hits. They know what they own. They know why they own it. They know what would have to change for them to sell, and they don't let short-term price movements force them into decisions they'll regret later. Let me give you another framework to think about this. Imagine you're watching a poker game. There's a big pot in the middle of the table. The players who have been betting aggressively suddenly start folding, one after another. From the outside, it looks like they all just lost confidence at the same time. But what if you could see their cards? What if you knew that one player at the table had raised the stakes in a way that forced everyone else to either go all in or fold? That's what happens when margin requirements increase in a crowded trade. The house changes the rules in the middle of the game. Some players can meet the new requirements, others can't. And the ones who can't are forced to fold, regardless of whether their hand was good or not. This isn't about the fundamentals of gold. It's about the structure of the market. And until you understand that structure, you'll always be at a disadvantage. Now, let me tell you what I think this means going forward. I want to be careful here because I'm not a prophet, and neither is anyone else. I don't know exactly what gold will do tomorrow, or next week, or next month. Anyone who tells you they do is lying. What I do know is that the fundamental case for gold hasn't changed. Central banks are still buying gold at historic rates. Global debt levels are still at all-time highs. Inflation may have cooled from its peak, but it hasn't returned to the levels that central banks target. Geopolitical tensions remain elevated. The reasons why people own gold haven't gone away. What happened this week was a mechanical event. It was a liquidation of leveraged paper positions, not a fundamental reassessment of gold's value. The physical market tells a different story than the paper market, and historically, when those two diverge this sharply, it's the physical market that tends to be right about where prices are headed next. I also know that this kind of volatility is not new, and it's not going away. If you want to own gold, you need to be prepared for moments like this. They will happen again. The question is whether you'll be positioned to weather them or whether you'll be the one getting liquidated at the worst possible moment. That means thinking carefully about how you hold your gold. Paper or physical? Leveraged or unleveraged? Allocated or unallocated? These details matter. They determine whether you're a participant in the market or a victim of it. They call it volatility. They call it a correction. They call it a healthy pullback. I call it the system showing you its hand. Every time this happens, wealth transfers from people who don't understand the mechanism to people who do. From people who are forced to sell to people who can afford to buy. From paper hands to physical vaults. You can be upset about it, you can call it unfair, but that won't change the reality. The only thing you can change is your own position. You can learn how this works. You can structure your holdings to survive the next liquidation. You can stop being surprised when the market does exactly what it's designed to do. The information is there. The pattern is documented. The mechanism is knowable. What you do with that knowledge is up to you. After everything you've seen in this video, I want to know where you stand. Are you holding? Are you selling? Are you waiting for a better entry point? Drop your answer in the comments. I read them. And if you know someone who panicked this week, someone who sold at the bottom because they didn't understand what was happening, send them this video. Not to make them feel bad, but because they need to understand how this works before the next one happens. Subscribe if you want to keep seeing these breakdowns. Turn on notifications because the algorithm doesn't always show you what you need to see. And remember, you don't fight this hard against something that doesn't matter. The fact that gold generates this much volatility, this much attention, this much effort to suppress or manipulate, tells you everything you need to know about what it represents. This is Jack Goldsman. Welcome to the Hidden Economy. I'll see you in the next one.